the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're listening to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take a quick look at how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of how we started. Well, Singapore shares began the day in the green, tracking a rise in other global markets. So when we look at the Straits Times Index, it opened 0.2% higher at 3,814 points after nearly 37 million securities changed hands in the broader market. Now let's take you through the closing numbers. We do see the STI closing marginally in the red, down 0.06% at 3,804 points. In terms of value turnover, that's 962 million Sing dollars. Now gainers outnumbered losers, 269 versus 193. Top advances for the day, we've got here Venture Core, Asus and Keppel, and top decliners for the day, we've got here GMXUSD, DBS and SGX. Now, in terms of counters to watch for today, we have for you Keppel DC Reit after its manager posted a distribution per unit of 4.902 Singapore cents for the second half ended December. That is up 13.2% from the previous corresponding period. Now, elsewhere, from Singapore's central bank easing monetary policy settings from the first time in over 2 years to how the Bank of Japan raised interest rates to the highest level since the 2008 global financial crisis. We've got more local as well as international headlines in focus for today. Now, joining me on the line is Sunny Soh, Lead Technical Analyst, Capital Markets and Investor Education at SIAS. Sunny, welcome.
Hi, Tian Tian. Thanks for having me on the show today.
Great to have you on the Friday edition of Market View as usual, Sunny. Now let's start with the Singapore stock market as usual. How did the STI fare today when it comes down to the counters to watch as well? Any surprises, say with Keppel DC Reit after that DPU of 4.902 Singapore cents for second half ended December?
Yes, on our STI index today, we are more or less flat, holding on to the 3,800 point handle. We are down just 2 points today, or 0.06%, to close the week at 3,804 points, despite major U.S. averages jumping between 0.2 to close to 1% overnight after President Donald Trump called for lower interest rates and cheaper oil prices at the World Economic Forum in Davos. But for the trading week, our STI is still slightly down by 6 points, or 0.17%, and this was after the 0.24% gain that we saw last week. And of course, STI hit a 17-year high the week before last at 3,887 points, and we are now back to the 3,800 point level and holding tightly to this level for now. And on the big movers on STI, I see Citrum rising 1.8%, Singtel rising 2.89%, and on Keppel DC Reit, which you mentioned, I also saw that it's up more than 2% today, from $2.21 to close at $2.25. And as you mentioned, they posted a 13.2% rise in their second half DPU to 4.902 Singapore cents. This is actually great news for unit holders and a bit of encouragement for the REIT holders in Singapore as well, given that we are in a high interest rate environment. So this brings the REIT total DPU, Keppel DC REIT total DPU for FY 2024 to 9.451 cents, up 0.7 cents on the year. And if we include the new units that were raised via a pro rata preferential offering, right, for the acquisition of Keppel DC Singapore 7 and DC 8, DPU for the second half of 2024 would have been 4.955 cents, up 14.4% from the previous corresponding period. So the higher DPU comes as a result of rent increases and distribution arising from the settlement sum related to DXC Technology Services in Singapore, as well as a contribution from their Tokyo Data Center 1. So this is despite the loss allowance for the Guangdong data centers and higher financing costs in first half of 2024, as well as the depreciation of foreign currency against the Sing dollar. And based on the closing price today, the REIT, based on the closing price on 31st December last year, 2024, the REIT distribution yield for FY24 was actually a respectable 4.3%. So there are still certain REITs that will still be able to perform well despite the current elevated interest rate environment that we are in right now.
Okay. Now, Sunny, let's take a look at the other counter, the other REIT to watch for today, OUE REIT. The manager announcing there that the DPU climbed 8.7% on the year to 1.13 Singapore cents for second half of financial year ended December. How far was that within your expectations? And would you say that as REITs in general for this earnings season, they performed relatively well, so to speak?
I think for the S-REIT sector as a whole, the performance is really promising because of the high interest rate environment that we are in now. So, although we are seeing positive results from hospitality and data centers, I can't really say the same for all the other S-REIT in the other sectors.
Okay.
And on OUE REIT, their second half DPU rose 8.7% to 1.13 Singapore cents from 1.04 cents a year ago. So this came as their revenue increased 1.7% on the year to 148 million Sing dollars from the 146 million corresponding period a year ago. So the growth here was attributed to the stable operational performance of the REIT Singapore office portfolio, as well as a successful asset enhancement of the Crown Plaza Changi Airport, which was completed in December 2023. But for OUE REIT, their net property income for the half year actually slipped by 2.3% to 117 million Sing dollars, as upward revisions of prior year property tax for Hilton Singapore Orchard and Crown Plaza Changi Airport caused the NPI to drop slightly. Joint venture results from OUE Bayfront, which also contributes to the NPI, doubled in the 6-month period to 26 million Sing dollars, mainly due to fair value gains, and the total amount available for distribution actually grew 3.7% on the year to 59.9 million Sing dollars, offset by the payments of 50% base management fee in unit in Q4 FY24 and the removal of working capital retention. If we include the release of the remaining 2.5 million capital distribution from the 50% divestment of OUE Bayfront, the amount to be distributed to unit holders will be 62.4 million Sing dollars, marking the 8.88% year-on-year increase that we see. And for the full year, OUE REIT announced a DPU of 2.06 cents, which is down 1.4% from the 2.09 cents that we see in the year-ago period.
Okay. Now, Sunny, staying in Singapore Central Bank, the MAS, eased monetary policy settings today after having held them steady for more than 2 years since the last tightening move, which was all the way back in October 2022. Now, the Monetary Authority of Singapore, the MAS, said it will slightly reduce the slope of the SNEER, or the Singapore dollar nominal effective exchange rate policy band. There's no change to the width of the band, as well as the center point or the level at which it is centered. I believe the move was widely expected by analysts, but really what do you think is next for Singapore's dollar SNEER?
Yes, indeed. Several economists actually had expected MAS to ease monetary policy settings and slightly reduce the slope of the SNEER policy band following the latest December data that we saw, given authorities' relatively dovish tones taken then. So this suggests a modest and a more gradual appreciation path for the SNEER, and this implies a continued, although a slower, strengthening of the Sing dollar against the trading partners' currency. So the rationale is in line with MAS aims to actually maintain medium-term price stability, and a gradual appreciation of the SNEER policy band will continue to help control imported inflation. Additionally, Singapore economic growth is also projected to moderate this year, so maintaining a more rapid appreciation would actually be less desirable. So we will still continue to see gradual appreciation of the Sing dollars, leading to a more stable exchange rate environment, hopefully. But the key factor to watch will actually be inflation. Because if core inflation were to remain below 2%, further easing might be likely. But with the new president in US, Donald Trump, in office, it's difficult to say because his policies are viewed as inflationary. So if we see a resurgence in inflation, then things could change. And lastly, Singapore growth momentum shows some signs of a slowing down. Okay, and if a slowdown was significant, MAS may prioritize economic activity, leading to even a lesser aggressive appreciation path for the SNEER policy.
That being said, how far do you think the move by MAS today will bolster exports and the local Singaporean economy, especially when we look added against the bigger backdrop of how Singapore's factory output actually rose 10.6% on the year in December.
Yes, so this will likely provide more support to exports and local economy, given we have the fantastic 10.6% number we saw in December. So the aim to slow the appreciation of the Sing dollar will make our export more competitive in the international market. This could lead to increased demand for Singapore goods and services, particularly in export-oriented sectors like electronics and manufacturing. But the current global economic headwinds, including possible high interest rates and maybe geopolitical tension, will continue to pose challenges to our export growth. But overall, I think MAS move is a positive step towards supporting Singapore export and the local economy, and the impact is likely to be gradual and contingent upon global economic conditions. The 10.6% surge in factory output does provide us with a very positive sign, but the performance of specific sector and the overall economic outlook will be the crucial determinant of the effectiveness of this policy change.
If you're just tuning in, we're now in conversation with Sunny Soh, Lead Technical Analyst, Capital Markets and Investor Education at SIAS. Well, Singapore's not the only country announcing its monetary policy decision. Over in Japan, all eyes on the Bank of Japan because it raised interest rates to the highest since the 2008 global financial crisis today. So just to bring our listeners some context, the BOJ raised short-term policy rate from 0.25% to 0.5%. That is a level that Japan has not seen in 17 years. So how did Japanese equity investors react to the hike, and what are the implications on the Japanese yen then?
Yes, I think a lot of investors can still remember the Japanese yen carry trade impact on the markets last year. So this BOJ decision to raise interest rate now actually has a mixed impact on the Japanese market, with the yen strengthening and bond yields climbing, while the Nikkei 225 or the equities actually shed early gains. The yen initial rally against the US dollar is as much as 0.8% following the decision when it was announced. This was likely driven by BOJ's shift towards a more normalized monetary policy, which made the yen less attractive for carry trade. However, the yen gains were pared back after that, after BOJ governor stated that the rise in the underlying inflation was moderate and the central bank wasn't seriously behind the curve, suggesting that there is actually no rush to tighten the policy again. So the equity index Nikkei 225 initially rose as well, likely due to BOJ confidence in rising wages and stable inflation near its 2% target. This suggested a positive outlook for corporate earnings and economic growth. However, the Nikkei actually after that shed its early gains and ended the day down 0.07% at 39,931 points. So this may indicate that investors are still remaining cautious about the potential impact of BOJ's rate hike on corporate profits and economic growth.
Okay. Now, Sunny, you talked about Trump earlier. Let's talk about him. U.S. President Donald Trump, he said in an interview with Fox News that he had a friendly conversation with Chinese President Xi Jinping last week, and that he would rather not use tariffs against China. Now, how far can markets take heart in Trump's remarks, and how far have they considered his comments given price movements of Chinese and Hong Kong equities today?
Well, for me, myself, I'm actually glad to hear that. But his comments on the friendly conversation with Chinese President Xi Jinping and his preference to avoid tariffs against China did brought some relief to the markets. We did see that the Hang Seng Index rising 365 points today, or 1.86%, and the Shanghai Composite also rose 22 points, or 0.7% today. So markets did react positively to Trump's remarks, with both Hong Kong and Chinese mainland stocks experiencing significant gains today. However, I would like to caution investors that we will need to be wary, as Trump's past actions have often contradicted his words. And his previous threat of tariffs and his unpredictable approach to trade negotiation has created a sense of uncertainty that I think will continue to still linger around in the market. So the previous trade war with China has been a major cause of volatility for global markets, and I would be hesitant to fully embrace Trump's optimistic tone until concrete evidence of a lasting solution or a trade deal being signed. Even then, there may still be underlying issues that have fueled the trade war, such as intellectual property issues, China's unfair trade practice, and this may somehow remain unresolved. And Trump's statement that he still has tremendous leverage with tariffs suggests that he will still continue to use it, and that can potentially cause more market volatility. So the remarks do offer me a glimmer of hope for a potential trade deal, but I'm still taking a wait-and-see approach to see what he's really going to do.
Okay, and Sunny, I've got about 1.5 minutes to go. Really wanted to pose you this question. So let's wrap up talking about TikTok. Now, it seems like Oracle, Apple, and Google, they've diverged as to whether to continue serving TikTok, despite Trump's assurance that the government will not enforce the national security law that raised potential penalties for U.S. partners of TikTok. So, if we look at Oracle, it has kept TikTok operational since it went offline over the weekend. Apple and Google have removed the app from their app stores, but they've held off relisting the app. So how would you read into that divergence, though?
Yes, really, the big tech partners of TikTok really behaving differently after Donald Trump sort of keep TikTok alive. So the divergence among Oracle, Apple, and Google regarding their relationship and partnership with TikTok reflects the different strategic priorities or risk assessment concerning regulatory challenges that they see and market dynamics as well as public sentiment. For Oracle's decision to keep TikTok operation demonstrate that Oracle is commitment to securing a foothold in the growing social media space or market, which it doesn't really have a lead. By providing cloud service to TikTok, Oracle is actually positioning itself as a key player in the data management and cybersecurity arena, potentially benefiting from the increased demand for secure platforms from social media platform companies. In contrast, for Apple and Google, their decision to remove TikTok from their app store signal a more cautious or defensive approach, because both companies are likely weighing the potential risk associated with TikTok, including regulatory scrutiny and, of course, reputational damage if TikTok were to go down. Okay, so given this very significant difference in market positioning, some of them may prioritize compliance with evolving regulations over immediate business opportunities. So TikTok has a rapidly growing user base. I don't know, Tian Tian will be signing up for a TikTok account soon. And Oracle's support may allow you to capitalize on this social media trend that we are seeing.
Okay.
But Apple and Google may be more focused on their own user experience and user base, and of course brand integrity as well, opting to avoid the association with TikTok platform for now, afraid that they will face further scrutiny. So with the divergence among these tech companies, it indicates the various assessment or the risks and rewards that may be associated with TikTok, and it's still unclear if TikTok will continue in the US for the long term.
Thank you so much for the insights, Sunny. That was Sunny Soh, Lead Technical Analyst, Capital Markets and Investor Education at SIAS. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.